Hello and welcome. I'm Dennis, your cross-border tax specialist. Today we're going to delve into the complexities of managing your RRSP, RDSP, RESP, and TFSA accounts when leaving Canada. So let's get started. First, let's understand each account. RRSP is a registered retirement savings plan for retirement savings. Now, RDSP is a registered disability savings plan for those with disabilities or have dependents with disabilities. And RESP is for education savings. And then the TFSA is general savings with tax-free growth. In Canada, these plans offer significant tax benefits, but when you're no longer a resident, the benefits can change dramatically. For those moving to the US, one major concern you may have heard of is IRS Form 3520, which is required for transactions with foreign trusts. RRSPs, RDSPs, RESPs, and TFSAs are considered foreign trusts. Missing filing a 3520 can lead to substantial penalties, but the classification of Canadian accounts for US tax purposes vary, and tax specialists have a variety of opinions on these issues. The good news is that the IRS has issued a couple revenue procedures, which is their interpretations and their listed procedures. The registered retirement savings plans are specifically excluded by name. So we know that that one is safe. You don't have to report an RRSP on your foreign trust return, on a foreign trust return. The other three plans that I mentioned are not listed specifically, but there is a revenue procedure that generally exempts what's called an applicable tax favored foreign trust. The definition is pretty complex. In general, your other plans, the TFSAs, RESPs, RDSPs, are exempt. But like I said, the definition is complex, and some of it is based on your annual contribution limits. So you might want to take a look or get someone to take a look at that for you to just make sure that you're not required to file that Form 3520. Another important requirement to remember is your FBAR, your report of foreign bank and financial accounts. If your foreign accounts exceed $10,000 US, then you are required to file an annual FBAR form, which ensures compliance with US regulations on foreign accounts. You're now a US person, and so your Canadian accounts are foreign accounts for US purposes. And of course, your RRSPs, TFSAs, RESPs, RDSPs are included in that list. So you are going to have to report those on your FBAR, so don't forget to do that. Now looking at each account specifically, your RRSPs, of course, are tax deferred in Canada, meaning that you deducted the money from your taxable income when you contributed to an RRSP, and then when you withdraw, you have to pay tax on that RRSP. The good news is that the IRS has agreed to essentially mirror Canadian tax treatment. So when you do withdraw from an RRSP, you're going to report that income in Canada, pay tax on that income in Canada, that withdrawal in Canada, and then you're going to turn around and report the taxable withdrawal in the US and report a foreign tax credit on that income in the US. Now it will go against your taxable income or add to your taxable income, which might affect your Affordable Care Act health premiums. It might affect other credits credits and government payments and government involvement that you have. So you need to be careful with your tax planning there. Now, the other three, the TFSAs, RESPs, RDSPs, are a little bit different. Those lose their tax advantage status in the US. So although you're making some interest income in Canada on those accounts and you're not having to pay any tax in Canada on those accounts, you will have to pay tax in the US, which means that you don't get a foreign tax credit because you didn't pay tax in Canada, which means that you basically lose any benefit of having those plans. You also lose access to matchable grants that you might be getting in those accounts, especially the RESPs, and you're not allowed to contribute to these plans anymore because you're not a resident of Canada. So you've really lost any benefit in holding those plans. As a rule of thumb, I generally recommend, if you're going to be long-term in the US or permanently in the US, if that's the plan, I generally recommend withdrawing at least from those three later accounts, the RESPs, RDSPs, and TFSAs, and go ahead and open up an equivalent account in the US. The US and the states have some really nice plans that will help save for retirement, save for education, put money towards disability or disabled dependents, and build up your retirement savings. So um, yeah, I generally recommend just closing those accounts in Canada and opening up equivalent accounts in the US. Now the RRSP is a little bit different because closing the RSP is going to trigger tax in Canada, and it's going to increase your taxable income in the US. So you're going to want some planning, some professional advice to determine the right time to cash out that RRSP, and you want to talk to your financial advisors and your tax advisor. If you want personal advice, you can feel free to contact me. Otherwise, thanks for watching, and please subscribe for more insights on cross-border taxation. Thank you. Have a great day.